Welcome back. And now let's look at the hedge fund failures. Well, this is a very important quote. I can't tell you how to get rich quickly, but I can tell you how to get poor quickly. And that is by trying to get rich quickly, right? So often people lost a lot of money because they were too impatient and they just want to make a lot of money quickly. There's no shortcut, okay, right? So let's look at the hedge fund performance, right? We talk about the strategies and we can copy some of the strategies. And when we look at the actual performance after fees, what do we see? Well, we have seen that in the earlier times that they have some good successes and some not so bad failures. But from the year 2010 onwards, we have seen a consistent underperformance to the S&P 500, right? So you look at this, it's almost like, well, it's every year that they have lost money since 2010 after fees. And to put this into perspective, right, if you were to look at the S&P 500 total return over this period, and I ask you to guess where this dark line is going, right? So we had some success here. This is the hedge fund return index after fees. You might expect something like here, right? Okay, but you get this, okay, right? So the performance for investors that invest in hedge fund has been terrible, right? So I'm going to bring you behind the scene. Right? So this is Berkshire Hathaway. This is Warren Buffett company. If you're an investor in Warren Buffett, you would have made this kind of return. But if Warren Buffett had implemented the same fee structure, right, 2 and 20, then a lot of the performance would have been gone away from you, right, to the hedge fund people, right? Or in this case here, to Warren Buffett. Okay, so 2 and 20 is a lot of money because every year if you're paying 2% fees on your asset under management, right? After 10 years, we will be looking closer to 18, 17%, right? After 20 years, right, very serious money. And on top of this, right, for every $100 you make, right, $20 go to the hedge fund. If you lose $100, they're not going to reimburse you the fee, the $20 losses. Well, the big problem in the hedge fund industry is that although the asset under management have gone up rapidly, right, we have a lot more hedge fund, right? A lot more hedge fund. So the competition is extremely severe. Okay? And this also contribute to a lot of closure, right? Partly because as a group, they have not performed well compared to S&P 500. And also there are just too many hedge funds, right, fighting for the asset under management. If you were to look at the breakdown and you look at the small guys, the small guys are the hedge fund that manage less than $100 million. Right? You will find that their annual company expense comes out to be about 2.4, 2.2%, compared to the bigger guys that has more than $10 billion AUM. Right? Because the bigger hedge fund, right, they have the economy of scale, whereas the smaller hedge fund, they don't. So hedge fund charges 2 and 20, right? So if the expense cost them more than 2%, so this smaller hedge fund, like, they are just barely breaking even, right? Why? Because the hedge fund costs a lot of money to operate. Initially, an aspiring hedge fund manager may be working from home, right, with just a laptop and do a lot of number crunching, right? or may work in the coffee shop nearby. And you can see the problem now, right? Because the this uh, this small hedge fund or somebody who's trying to become a hedge fund manager cannot simply say, right, I'll meet you in Starbucks and I'm the guy with the laptop, right? That would not have any credibility. Nobody's going to want to invest money with somebody who's working out of a coffee shop, right? So a hedge fund needs what? A hedge fund needs a simple reception place like this, and you cannot leave it empty. You need to hire somebody to stand here. The job is just to wait for the elevator door to open and say, welcome to ABC Hedge Fund. And that person would cost, in New York City, would cost $45,000, $55,000 a year just to stand there. Okay, right? And then you need a space for the waiting room, and this costs money, right? And you need a trading room. You need a trading room, and every of these machine, if you have to subscribe to Bloomberg, it costs money, and you cannot have an empty office. Right? You need to have people, right? Every one of these, whether it's a portfolio manager or analyst, right, we are talking about analyst level, $100,000, $120,000. Portfolio manager, a good one could be at least $500,000 to $1 million or to $2 million, right? And you need preferably somebody that looks very serious, right? Preferably somebody who has formerly worked uh, for the Federal Reserve, supervisory team, or the examiners. And this person is a compliance person, right? A compliance person do not bring money to the, they do not come up with trades. Their job is to make sure that things don't go wrong, right? And somebody like this would cost anywhere to 300 to $500,000 a year, right? So all this costs money, and if you bring your client to the office, you don't want your client to look out the window and see a garage, right? And if you get a window like this, this costs a lot of money, right? So, for a hedge fund that has $100 million of asset under management, 2% is $2 million, doesn't go very far, right? Not in New York City, right? So after expenses, like the smaller hedge fund, they would start incurring a negative operating margin. So they rely a lot on performance, uh, just to catch up. Okay, right. And when we look at the average performance of hedge fund, you see that the larger hedge fund, they tend to do a lot better than the smaller hedge fund. Right? Why? Because in the hedge fund community, the most valuable asset is the first call. Right? What's the first call? Well, suppose something happened right now, right, during the normal trading hours. News just came out, and the salespeople at one of these logo companies, Morgan Stanley or Goldman or JP Morgan, right? The salesperson have to share this news and the analysis with the client, right? So who would they call first? Obviously, they call the large hedge fund people first, right? And after they've called these large hedge fund people, and by the time they get to this smaller hedge fund, that would be at least 3 hours, 4 hours later, and the market would have moved, right? So the large hedge fund people have the benefit of this first call. So the world has changed dramatically from 2 to 20. Now the average is 1.45 as the annual management fee, and the incentive fee, the performance fee, is no longer 20%, it's now only 17%. Okay, right? So the hedge fund community is very, very crowded. and now the fees have come down quite significantly. So what happens when the market is so tough, right, to be profitable and to grow, right? Well, the sad story here is that many of them resort to cheating, right? Here I'm going to walk you through some of the ways they cheat. It is still very common to find hedge fund involving in insider trading, right? Because the market is about getting an information edge, but it is about getting the information edge legally. But we do have cases like this, and people are caught. And if you subscribe to the SEC website, they will tell you every now and then the people that they are catching. And sometimes you get big headlines, and but uh, the smaller guys do get caught every now and then as well. The other one is Ponzi, like Ponzi scheme, and who would have thought that Madoff, right, has built up this huge fund management company simply because he was able to come up with all this fake accounting and get people to believe him. Then we have these cases every now and then. We have this guy who is a founder of this hedge fund in New York, and he lost all but $200,000 of the firm capital from $100 million. So $100 million, he lost almost all down to about $200,000. And what did this guy say? Well, this guy say, I take responsibility for the terrible outcome, but it is no consolation to the people that had trusted him and invested money with him, right? So this is, when if the manager says sorry after they had what we call the OPM, right? They've taken on enormous risk with OPM, with other people's money, right? Because the structure of this industry is biased, right, towards encouraging the hedge fund to take a lot of risk. Because if they take a lot of risk, if they make money, they get 15 or 20% of the outperformance. If they lose money, then they will send you a card and say they are truly sorry. Okay, right? So the incentive structure is very, very lopsided. Then we have this very strange situation, right, that create this kind of opportunities for wrongdoing every now and then. Suppose in the simple case study, the hedge fund had bought $10 million of 1 week call option on Apple before earnings announcement. And the earning announcement came out, great earnings numbers, and with a positive guidance. And Apple shares is up 5%, and the call option is up X%. Right? Okay. And if this hedge fund is managing 3 funds, global strategy, US tech opportunities, and US Asian alpha, if I were to ask you, where would right, where would this hedge fund put this winning trade, right? So I'm going to give you 5 minutes. You can pause here and think about where would this hedge fund put this winning trade. Would it be in A, B, or C? Right? You can pause now. Okay, now welcome back. Well, the answer is depend on where the hedge fund manager has his or her own money. Okay, right? Whether he or she has her own money. If her or his own money is in global strategy, that's when he will put the winning trade. Okay, right? Again, as I said, if you subscribe to SEC, you'll see these things quite often. Here, this guy, he purchased option in an ominous or master account for the hedge fund and delay allocation of the purchase to either his or his client's account until later in the day, right? After he saw whether or not the securities appreciated in value. His personal trade in this option had an average first day positive return of 6.28%, and his client's trade in this option had an average first day loss of 5%. Right? So this is cherry picking. Right? Cherry picking, where the hedge fund will put the winning trade into the fund where they have a personal interest, and they put the losses into the fund that may likely where you have your money there. The fifth way is to think about how do we mark to market. For stocks, we can mark to market every day. Right? At the end of the day, 4 o'clock closing, we have a price, so we can mark to market. Treasury bonds, same thing. But for high yield and a lot of structured products, there is no regular pricing. There's no regular pricing because they are not traded often. Right? The law allowed a company like Alpha Bridge, right, that it could obtain the price code from brokers, right, for certain unlisted and thinly traded residential mortgage-backed securities, and for them to pick the average of this quoted price. Okay, right? That's the law, right? However, some hedge funds abuse this, where they would collude with the broker dealers and say, I need a quote from you to mark the market, but I'm not going to sell it to you. I just need a higher price so that I can mark it at a higher price to show my clients that this particular residential mortgage-backed securities or high-yield bonds is making money, right? So, and sometimes instead of relying on the brokers to give the prices, this hedge fund would then secretly give their own estimate and say, please use this price. Okay? So this is collusion, right? It's collusion, and even a large company like PIMCO, they also get into trouble because PIMCO being a large hedge fund, they also employ younger people, and then sometimes if younger people are very tempted and they get into trouble with this kind of collusion. Okay. So this is the one of the ways where the hedge fund would cheat, right, using the structured product pricing. So my advice to my clients when they want to invest in any hedge fund is to look at the kind of investment that the hedge fund specialize in. If I see a lot of structured products or bonds that are not easily tradable, then I would be very cautious about this, and I would want to get some kind of an independent verification and see that some of this valuation compared to the past numbers have been reasonable. Then number 6 is the pump and dump, right? Pump and dump, a very good example here would be this hedge fund guy, where he would quietly accumulate as much as 84% of these outstanding shares in this company. And then when he is able to pump it up, then he would dump it and let the share price collapse. Right? And typically the way they do this would be, they will send the email to a lot of unsuspecting investors and say, this particular company has found the cure for cancer, or the cure for this particular virus, or this company has developed this particular app that cannot be easily duplicated and likely to be bought over by Amazon or Facebook. So they come up with stories like this, and then they will say, look at the share price, it has been going up nicely the last 3 weeks, and this could go up to $100 or $200 or whatever, right? So the investors who don't do the homework, they read this kind of thing, they get tempted, they are greedy, and when they buy into this, that's when these hedge fund people would dump it, right, and leave these investors holding the bag. Then this guy really take the cake. Right? He is a champion on this rogue list. This guy, Mark Malik, right, he claimed to be a hedge fund manager, and he solicited investors with promises of consistently high return. Right? So again, right, I cannot teach you to become rich quickly, but I can show you that people who want to be rich quickly would believe something like this, and they will lose their money. Right? So Malik was able to raise $840,000 from investor, but he never really made any investment. Right? And he created a fictitious Amanda Abbott that he identified as an investor relation. And then what did he do with this money that he raised? He spent it all. He spent it all. And for people who want to redeem the fund, he will say sorry, or he will ignore their request. And he even created a fictitious fund employee who sent one investor an email claiming that he had died. Okay, right? So obviously, Malik is caught, and I think he's still in jail right now. Right? But there are others like this that we see every now and then. And again, I recommend that you sign up for the SEC email and keep up with all this news and learn more about the hedge fund community. So this concludes our segment for today, and I hope you enjoy all these classes here. Right? Thank you.